video, we're going to switch to the new topic, 8.3, and this is about central banks. So central banks are a little different from just regular old banks. These are government financial institutions, and in the United States, we call it the Federal Reserve. The Federal Reserve. Now, I'll have to tell you right at the very beginning, the Federal Reserve, as the central bank of the United States, has a slightly unique structure. I'd say, well, you can't have slightly unique. It has a unique structure in that it's both a government bank, a government financial institution, and it's privately owned. And we do not need to get into all the weeds of the structure of the Fed for this course, but I do find it very interesting, and I would encourage you to maybe do a little bit of looking on your own about the structure of the Fed and how decisions are made there. But in general, we would say that central banks are typically government financial institutions. Now, these financial institutions have special or privileged control over the production and distribution of money. They are the monetary authority. In other words, they control the money supply, the supply of money. And that's what we call monetary policy. So they're typically responsible for formulating monetary policy and regulating banks. Now, the Fed has 5 functions: conduct monetary policy, obviously, but they also maintain financial system and institutional stability by regulating banks, and they maintain the payment system of the United States, and that means that they clear checks, actually. So I'm going to say parentheses, clear checks. So if I write a bank check and it's written to someone else, then that someone else actually can cash their check at their bank, and the Fed is the one that maintains that system of how the money goes from one bank to another. And then finally, they promote consumer protection. They try to inform consumers and promote financial literacy. Now, in terms of what our concern is for this course, we are going to be really concerned with the first one, the conducting of monetary policy. And they generally have 3 tools to do that. They have their required reserve ratio, they have the discount rate, and they have the federal funds rate, which sometimes we call that open market operations, is sometimes what that's called. And all three of these involve changes in the money supply. That's what they all do. They all do that. All of them change the money supply. And this table down here at the bottom explains how changing the money supply could affect unemployment and price levels. And these are the 2 things that are the mandate, which is the requirement of the Fed. And we would say that the Fed is actually required by law to keep price levels low and stable, so at about 2%, positive 2%. And then they also are required to keep unemployment down, to keep the unemployment rate down at about, we'll say, 5%. And now the Fed chooses these numbers, right? The Fed says, okay, we interpret stable and low to be 2% inflation, and we interpret low unemployment to be 5%. But generally speaking, that's their job. That's their job, is to make sure unemployment and price levels don't get out of hand. Now, before we get into any of the tools, we can erase all that stuff for just a second, and I want to show you kind of some part of this that we already actually know how this works. So what we'd say is that if consumption and investment went down, aggregate demand would go down. Output is part of that, and so that would decrease, and unemployment would rise, and price levels would fall. That's the idea, and if we need to, we can draw a little picture down here of aggregate demand and aggregate supply. And we'd say if that consumption and investment went down, that would cause aggregate demand to decrease. And so output would fall from Y0 to Y1. And when output goes down, unemployment goes up. And we'd say price levels would fall. So this chain of events, consumption and investment going down, aggregate demand, all this is stuff we learned in Unit 7, actually. And so this mechanism, link chain, I'm not going to spend a lot of time explaining. But we can say that if consumption and investment goes up, aggregate demand goes up. So output goes up. So unemployment would fall and price levels would rise. So used during a recession, right? This is an important point. We'd say the Fed uses this tool, decreasing the reserve requirement. We'd use it in a recession because we'd want there to be more output and more jobs, so less unemployment during a recession. And we would use this one, conversely, increase the reserve requirement in an expansion. So when the Fed wants to brake on the economy, to pump the brakes and maybe lower price levels a little bit, inflation's getting too high. If we want to lower output a little bit, we could increase the reserve requirement. Now, we haven't explained how any of that works yet, but it is useful to see this part of the link chain before we quite get to this stuff. So we're going to fill out the rest here and just say decrease consumption and investment, decrease aggregate demand, decrease output, unemployment goes up, price levels go down. And then we're going to reverse the direction of those arrows here as well. And then we're going to say sell bonds, so that would make consumption and investment go down, and that, and that, and that, and that. And again, we're gonna figure out why consumption and investment does what it does in just a few minutes. But first, we want to fill out this portion of it, just because it'll let us see the picture at the very end, actually a little bit nicer. So again, all of these, right, would be the same thing. We'd use in an expansion and in a recession. We'd use in an expansion and we'd use in a recession. And so all three tools do basically the same thing. They all either increase unemployment and cut price levels, or they decrease unemployment and raise price levels. They all operate on the demand side. That's a useful thing to think about. All the changes in the money supply ultimately change aggregate demand. That's the idea, is change the demand side. So this monetary policy is always going to be aggregate demand. Now let's talk about how it works. So of the three tools, we've got one tool here, a second tool here, and a third here. Of the three, the first and the second one on our list don't really get used very much anymore. And it's not important for why they don't get used for this course, but we should observe that 1 and 2 don't really get used. It's the third one that the Fed extensively uses to do monetary policy and affect the economy. Now, let's talk about the first tool, increase or decrease the reserve requirement. This is going to change the money supply in the following way. If there is more of a required reserve, a higher requirement, it would decrease the excess reserves and loans. So there's less lending activity that could happen because the bank can't loan out as much. So that has the effect of decreasing the money supply. The reverse is true. If we lower the requirement, it increases excess reserves and loans. It makes it easier for banks to loan out money because they don't have to keep as much, and so the money supply gets larger. Now, we still haven't explained how changing the money supply ultimately affects consumption and investment, but this is the part where we're going to do that. So if we said the money supply goes down, that's going to have an effect on the interest rate. That's what that lowercase I stands for, is interest rate. And here's how it does. Think back to when we studied the idea of supply and demand, right? We just have prices and we have quantity. And we'd say you have a certain demand for something and a supply of something. And so if these are, say, strawberries, and if we said the supply of strawberries decreases to S1, what happens to the price of strawberries? Well, they go up. And likewise, if we said the strawberries increased in supply, the price would go down. The same is true of money. If we have a decrease in the supply of money, the price of money will go up. And we call the price of money interest. It's just how much it costs when you go to borrow some money. It's the price of money. So if the supply of money goes down, the interest rate will go up. And likewise, if the supply of money goes up, the interest rate will go down. This has a direct effect on consumption and investment because these are interest sensitive. Lots of people finance their consumption and investment through borrowing. So if we make it more expensive to borrow, and more costly to borrow because the price is higher of money, then investment and consumption spending would go down, aggregate demand goes down, output goes down, unemployment goes up, and price levels go down. And so that would be the targeted goal, is make price levels go down, and maybe unemployment is a little too low, so we want to increase unemployment. Usually we don't like to say that part out loud. So increasing the reserve requirement would accomplish that, and likewise decreasing it would accomplish these last two. Now let's talk about the discount window. Now, two things to understand here. First, banks actually can borrow directly from the Fed. And why might they want to do that? Well, there is every single night at about 5 o'clock, bankers turn off their terminals and they go home. And they've got someone in the back who basically looks at it and says, how much money do we have in reserves? Do we have enough money sitting there in reserves? And if they don't, why, then they have a little bit of a problem. they could either borrow that money that they need from the Fed, or they could borrow it from another bank. Now, typically what banks like to do is get it in this overnight market from other banks. And so if they can't get it from them, from other banks, we'll include that phrase, they could get the money directly from the Fed. Now, there's reasons for why banks might want extra reserves, right? Maybe tomorrow, the very next day, they know their very first customer is going to be a great big corporation that needs to make payroll. And so they might need extra cash tomorrow, and they don't think they're going to have it. Or maybe they did lots of lending activities today, and so they're kind of short on reserves, right? There's a variety of reasons why they might not have enough in reserves, but the two options are borrow from the Fed or borrow it from other banks. Now, if they borrow it from the Fed, they borrow it from something called the discount window. And it used to be that the Fed actually wanted banks to come to them first. So the Fed would provide kind of these really short overnight loans, just so that banks could have enough in reserves. They would do it at a discount compared to what other banks would charge. So they'd say, well, come to us and we'll charge you a discounted interest rate. And so here's how that affects the money supply. This is kind of the wonky part. If the discount rate, if the discount rate is set higher, then that's going to discourage banks from sending out lots and lots of loans, from taking risks during that day and loaning out lots of money. Because at the end of the day, if they have to go borrow from the Fed, then the discount rate is really high. And that's really punitive, right? They'd go, I don't want to have to pay this really high discount rate, so I'm not going to get into a situation where I might need to get that money. And that has the effect of decreasing the money supply, because the bank goes, I'm not going to lend out all that money today, even though I've got it, because I really don't want to get into a position of having to borrow from the Fed. So increasing the discount window rate would decrease the money supply. And likewise, decreasing the discount rate says, well, it's not that bad. If you have to go to borrow from the Fed, it's not that bad. The discount rate is pretty low. So it's okay if we get a little overexcited about lending and we lend out so much money today. And so if the worst case that happens, we just borrow from the Fed, and it's pretty cheap to do that if the discount rate is set low. So that would have the effect of increasing the money supply. Now, the same story that we told before about the effect on the interest rates and the effect on consumption and investment and so forth continues through. So if we increase the discount rate, that would reduce the money supply. And if we decrease the discount rate, it increases the money supply. Now, the last part, the last tool of the Fed, this one actually does get used quite frequently, and we're going to see lots and lots of exam questions about it. And this one is called open market operations. And the idea here is that, remember that banks could borrow from other banks in that overnight market. So let's say you're a little short on reserves. Well, what you'd do is you'd borrow from another bank to meet your reserve target. And the federal funds rate is the interest rate that's charged in that market. So that's the rate that banks charge each other, right? Bank to bank. So this is not a rate that the Fed directly controls. They can influence it, but they can't just change it. Now, they could just change the discount rate because that's the rate that the Fed charges banks. But the federal funds rate, that would be like the Bank of America lending money to PNC Bank. And the Fed can't force Bank of America to charge a certain interest rate. But what they can do is influence that interest rate. And they do that by doing this thing called open market operations. This just is a fancy name for buying and selling bonds held by banks. So in short, what the Fed does is it can go to banks in this overnight market and say, banks, I'd like to buy some of your treasury bonds. And this assumes that those banks have, right, some bonds in their balance sheets. Here we see this Bank of Clayton has $7,000 in bonds. So what the Fed would do is they'd say, we'd like to buy some of your bonds. And they provide excess reserves in exchange. So the bond goes to the Fed, right? The Fed just sticks it in its back pocket and holds on to it. But the Fed credits the bank with cash. They say, here, have some cash. So we'd say, we'd like to buy $10 million worth of bonds. And if they do that, that just goes onto the bank balance sheet and replaces, so from a bank balance sheet, it would change this $7,000 into excess reserves. So and I'm going to use this actually as an example here. If the Fed bought $5,000 worth of bonds, this becomes $2,000. This becomes $5,000. So from the bank's perspective, nothing changed, right? The bank has the same amount of assets that they did before, but they now have more reserves. So first off, it directly has the effect, if they buy bonds, of making the money supply bigger. It literally creates new money, right? The money supply is bigger. So buy bonds bigger is the way to remember that. That's the direct result. But it also has the result of lowering that federal funds rate. So it pushes the interest rate down directly because now there's more reserves out there. So it's cheaper for banks to borrow from other banks to meet their reserve targets. So if they have the goal to borrow some cash and get some reserves, it's cheaper for them to do that because there's more reserves out there. The bank can also, the central bank, the Fed, can reverse the process. If the Fed wants to, it can sell bonds to banks. It can say, "Hi, anybody want to sell me bonds?" And so they'd say, well, they'd sell bonds. The Fed would sell the bonds to a bank. So in this example, maybe they sell $5,000 worth of bonds to the Bank of Clayton. So the Bank of Clayton, it would go from 5, it would go back to 7,000. They sold them 5,000, so now this bank has $5,000 more in bonds. And what do? Well, they just delete the excess reserves and they say, nope, now you have 0 excess reserves. So they just switcheroo back those bonds came back over to the Bank of Clayton. Well, you saw the effect. We went from $5,000 in excess reserves to 0 in excess reserves. So that makes the money supply smaller. So when the Fed sells bonds, they take the reserves from the banks, they give the banks some bonds that have been sitting in their back pocket for a while. The Fed keeps about a couple $1 trillion worth of bonds just to do that. And they say, here, we'll just delete from your account that extra money and we'll give you some bonds to pay for it. And that has the effect of making the money supply smaller and the interest rate higher. So the 3 tools of the Fed, the first 2, reserve requirement, discount rate, don't really happen very much in practice these days. The third one, really, really important. So hopefully you took some good notes. I'll see you next time.